Welcome to RBC's Markets in Motion podcast, recorded June 24th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, the Duke CFO survey highlights how C-suite confidence has remained steady, with monetary policy and automation in focus. Second, our new valuation stress tests suggest that the S&P 500 has been baking in very optimistic views on inflation rates and the Fed. And third, recent funds flow trends point to a lingering desire for a shift in market leadership. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that if you found our podcast and our research generally helpful over the past year, we would truly appreciate it if you took a few minutes to vote for us in the Institutional Investor All-America Research Survey in the Portfolio Strategy category. This is the last week that voting will be open. The survey is scheduled to close on June 28th. Portfolio strategy is a highly competitive category, and the results are often used in the financial industry as a litmus test on which strategists are good at their jobs. If you think we fall into that category, and we think that most of you probably do since you're listening to this, we hope you'll take a few minutes to add us to your ballot. Now let's jump into the details of the market. Starting with takeaway number 1. C-suite confidence remains steady, a good data point for stocks, with monetary policy and automation in focus. Last week was a little bit light on economic data releases, and it was the Duke CFO survey that really caught our attention. We feel like we learned 4 key things. First, C-suite views on the broader economy were flat in 2Q, but remain in a recovery off 2022's recessionary low. Optimism on one's own company continued to outpace optimism on the general economy. Second, cost pressures and inflation, along with non-labor cost worries, rose, while worries about labor quality and availability, as well as demand, eased. Monetary policy remained the biggest concern, with no real change in level of concern since the last survey. Third, more than 2/3 of respondents said the U.S. election is not impacting investment plans, but those who say the event is causing them to postpone, delay, or scale down their plans wasn't insignificant. This is something to keep an eye on, as it's an issue that investors have been asking about in our recent meetings. And fourth, automation and AI have been a higher priority for larger firms than smaller firms, highlighting yet another disadvantage for smaller companies relative to larger companies. Moving on to takeaway number 2. Our new valuation stress test suggests that the S&P 500 has been baking in optimistic views on inflation rates and the Fed. We've added a new stress test to our valuation modeling. This is an optimistic scenario which bakes in lower inflation, lower 10-year yields, and more Fed cuts than the current consensus is anticipating. Our specific scenario bakes in PCE of 2.2%, 3 cuts, and 10-year yields that fall to 3.75% at year-end. To be clear, this is not our base case for year-end 2024, but it was a helpful exercise in terms of understanding what the stock market may be pricing in right now. These assumptions imply that a reasonable trailing PE for the S&P 500 at the end of this year would be around 22.5 times, and that a fair value for the index would be 5,500, assuming bottom-up consensus EPS of 245 is in the right neighborhood. That 5,500 index level is actually pretty close to recent highs. While we consider our valuation model to be a compass, not a GPS, our work here nevertheless continues to make us worry that the U.S. equity market has perhaps gotten a little bit ahead of itself in the short term due to a little too much optimism around rates, inflation, after the latest CPI print and Fed meeting. We'll wrap up with takeaway number 3. Recent funds flow trends point to a lingering desire for a shift in stock market leadership. Flows to U.S. equity funds have been pretty positive recently, with nothing remarkable going on in the aggregate aside from being below peak. But we did notice a number of interesting developments underneath the surface or in other geographies recently, which all point to a lingering appetite among market participants for a rotation in leadership. In terms of other regions and countries, as we expected would be the case given recent political developments, flows to European equity funds have deteriorated, undoing the improvement that had been seen in recent months. Nevertheless, flows to other areas, including Canada, Australia, and EM, have been improving and are also turning positive. Within the U.S., flows to large cap equity funds are still positive, but they're actually pretty well below peak. At the same time, small cap equity funds are seeing improving trends, driven by a return of inflows to passively managed small cap funds. In terms of sectors, there are also some early indications of a possible shift in preferences. Specifically, we are starting to see hints of improvement or stabilization in flows to cyclical and commodity sectors, most notably energy. Utility flows are still positive, but have admittedly faded from peak. Elsewhere in the AI and related industries trade, we aren't seeing any deterioration in growth or tech flows yet on our data, which does measure a 4-week average, but we have been struck by how sharply positive the recent inflows trends have been to these areas. We will be keeping an eye on these two categories in the next few weeks to see if there's been any sudden shift that contributes to our understanding of why the large cap growth trade and tech trade stumbled as last week came to a close. We do note that tech and growth inflows have been close to or above high water marks recently, raising the possibility that the tech growth trade simply needs to rest. That's all for now. Thanks for listening, and be sure to reach out to your RBC representatives with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.